macroeconomic headlines will be dominated by no fewer than 4 central bank interest rate decisions in the coming week. The Bank of Canada and the US Federal Reserve on Wednesday the 17th, the Bank of England on the 18th, and the Bank of Japan on Friday the 19th. Economists think the Fed is certain to cut and that the Bank of Canada might. The Bank of England is expected to hold rates at 4% after last time's narrow decision to cut, and the Bank of Japan is seen as standing pat as well, albeit with a quarter-point increase to 0.75%, seen as likely in the final 3 months of the year, depending upon the results of the Liberal Democratic Party leadership election. Now, the Bank of England is torn between sticky inflation on one side, weak growth on another, and has to try and keep government borrowing costs manageable in between, not least as gilt yields form the reference point for mortgages and other forms of bank lending, which in turn can shape demand for credit and overall economic growth. Anyway, 3 companies are due to report in the week ahead who could give us an insight here in some way, shape or form, and they are land and regeneration property specialist Harworth on Tuesday the 16th, housebuilder Barratt Redrow on the 17th, and omni-channel retailer Next on the 18th. After a roller coaster ride, as investors' perceptions of the UK's economic, inflation and interest rate outlook has changed, shares in Harworth actually stand near a 10-year high. Hopes for interest rate cuts, lighter planning regulations, and investors buying into Chief Executive Linda Shillaw's plan to drive net development value to £1 billion by the end of 2027, compared to 2024's 720 million, well, they've all helped with the latest uplift. The company focuses on the North and the Midlands and industrial and logistics and residential end markets. Watch out for news on asset disposals, planning approvals, land bank, and also site acquisitions, especially in light of how the August trading update flagged how lead times for concluding sales had lengthened a little bit, and the timing of value gains had become less certain, with the result that deals were more likely to materialise in 2026 and beyond. All of those trends will help to shape the first half headline results and where the benchmarks are provided by the interim figures from last year, and they are operating profit of 21.1 million in the first half last year, a dividend of 0.489p per share, net development value of 687 million, and above all, net asset value per share, a key measure of valuation as well as performance. This was £650 million a year ago, and at the end of 2024 had reached £692 million, or 214 pence a share. Another company with its finger on the pulse when it comes to inflation, interest rates, planning and consumer sentiment is Barratt Redrow. Its shares lurk near 5-year lows. The full year results to the end of June were well trailed by July's trading update, so attention may focus more on any outlook statement that Chief Executive David Thomas feels able to give. 2 months ago, Mr. Thomas noted that completions for the year just ended came in at 15,565, with a plan to grow that to around 17,500 in the new year just begun. And the underlying pre-tax profit would meet consensus forecasts at around £580 million in the year just finished, excluding costs relating to cladding remediation, restructuring costs, a settlement with the Competition and Markets Authority, and legacy property liabilities at Redrow. That equates to around £350 million against £171 million on a reported basis. Analysts will also look for comments on pricing, input cost inflation, progress in extracting synergies from the Redrow purchase, and especially reservation rates, which improved to 0.64 units per outlook per week in the year just ended, up from 0.58. However, Barratt Redrow has already noted how planning delays would limit outlook growth to around 0 in the coming year. The final area of interest will be cash returns. Barratt Redrow is running a £100 million share buyback, and the analyst consensus is looking for a dividend per share of 16.8p, up from 16.2p in the year to June 2024. Finally, we come to Next, buoyed by a tremendous run of better than expected results and earnings forecast upgrades. The shares powered to a new all-time high this summer, although they've slipped a little bit since, despite a relaunch of the share buyback and also the possibility of a special dividend early in 2026. July's update set the scene for these results by upgrading full-year, full-price sales and pre-tax profit estimates once more to up 7.5% and to £1.105 billion respectively. Any further review of guidance from boss Lord Wolfson will likely be the key here, although note that the headline comparisons from a year ago for these first half results are sales of £2.9 billion, pre-tax profit of £432 million, earnings per share of 282.8 pence. Attention will then switch to those cash returns where the interim dividend was 75p in the first half a year ago. Analysts expect 80p a share for the first half distribution this time around. Thank you for watching. Hope that you and your families are all keeping well, and I look forward to seeing you again next time.